Aldo Flores Quiroga, former Deputy Secretary for Hydrocarbons for Mexico and also Senior Advisor at FTI Consulting. David Elward, Pricing Director for Energy Transition at General Index. Nice to have you with us, David. And joining us quite soon, hopefully, will be Daniel Rahmat, Senior Energy Security Consultant in Iran. So great. Thanks for joining us, gentlemen. Great to have you. Aldo, let me go to you first. Welcome back. Great to see you. I wanted to come to you with a big picture sort of question we've been putting to some of our speakers this week, which is, we obviously have a bearish market, more or less, at the moment. Brent is under pressure for different reasons. But one question we've been putting to people is, why is this happening? And, the whole China argument has been being made, China demand. But would you say that's primarily what's driving it, or is it a nervousness on the macroeconomic front globally?
Well, both are combined, right? The macroeconomic picture globally does not look as strong as one would have thought or expected. You're seeing the European Central Bank making another interest rate cut. The US is still evaluating what's the next course of action. China is also loosening some of the risk from credit. So if at all of these things point to a reduced, to a weak demand, or at least not a demand that will increase in any significant way soon. And then you have that coupled with the increases in production that we're seeing in the Americas, which add up to the possible increases in production from the OPEC plus countries. Sorry. So that's why, and the signals are definitely not pointing to a bullish market, at least for the next few months.
And I mean, just to stay with you, Aldo, on that front, we have increasing production in America and the Americas. And we also have, though, planned, small volume increases from OPEC plus from December onwards. I mean, do you think that's realistically going to happen? They postponed that already once. Things could change, obviously, but all things remaining equal, is that a good plan, do you think, by OPEC plus? From a price protection point of view,
Well, my take is that this all depends on how production in the Americas continues to evolve. That is the main source of production growth. And OPEC has, in a way, been adjusting to that reality. So we'll have to see more of this. We do see very strong increase in production from Guyana. Brazil keeps its production being strong. We know the story from the US and Canada. Mexico is basically stable. We don't foresee much significant increase soon. Argentina is increasing its output. So you have all these drivers that are making it more difficult to make the calculation for balancing the market, and while at the same time keeping let's call it a fair share of market participation from all these players.
Okay, thanks, Dr. Aldo, for that. David, welcome again. Good to have you with us. Let's talk a bit more, get down to the nitty-gritty of what crude and products are doing in the market. I mean, we've seen, crude is doing what it is. It's at $70 more or less now, up and down. We've seen some volatility in the last month. That was very much linked to geopolitical factors when it went up to 80 and back down again pretty quickly within a couple of days. How are the geopolitical events or sentiment, let's say, we haven't had too much happening in the last 2 weeks in terms of the Iranian factor. How is that impacting, sentiment and movement even of crude oil products in the region?
Yeah, thanks, Dala. It's great to be back. Well, look, I mean, I popped into my Google search engine geopolitics oil prices last night just to see what's going around, right? And it pops up with a little AI produced message that says geopolitical factors can have a significant impact on oil prices, but the relationship is not always clear. And I think that we're always stuck with this challenge of reading into the prices, or tempted to read into what and attribute them to specific events. Look, it's very clear. Well, I think that it is clear that there has been a relationship between geopolitics and oil prices. We only see, I think that's kind of translated into some of the volatility with the other factors that Aldo has discussed. Prices, look, you described them. They've been in sort of kind of quite steady through the summer. Well, I say steady-ish, but relatively steady given the last couple of weeks, around the sort of like between 75 and 80. Then we slumped right below 70 and then spiked back up towards 80. And now we're like today seems to be a little bit of a climb going on at the moment. We're up at about 75. I mean, one of the other, so we have to take account, like it's a bit of a roller coaster, right? You look at the charts and it's very, very up and down, very choppy, very, very volatile. And kind of when you've got geopolitics and the unpredictability of the various events going on in the Middle East, then you're going to have those type of price trends. It's kind of challenging if you've got a position out there and something that people will be looking at quite closely.
And I mean, on the volatility front, we had somebody on earlier this week who was saying that it's never been, both on the up and down side, there's never been so much uncertainty around where the price could go. But would you be in agreement that, we are in a bearish market, and that the geopolitical premium has gone out the window, really? I mean, I don't see one in the price, certainly considering what's going on. Have attacks on Iranian oil infrastructure been dismissed by the market as they're not going to happen? Whereas, 10 days ago, it was being talked about.
They seem to have, right? I mean, I think you're right. I think that geopolitical premium seems to have faded this week. There's been some discussion that Netanyahu has signaled that he will go after, potentially if he goes after any targets, it'll be military, or provided some assurances that it won't be after oil infrastructure. And then, look, you mentioned the bearish factors. There's been a couple of reports out this week. OPEC in its monthly oil market report for October, which got released on Monday, slashed oil demand growth this year and next. It now expects global oil demand to grow by 1.93 million barrels per day in 2024. That was down 100 KBD from its last estimates, and it's cut estimates by next year by about the same amount, but next year demand growth is forecast at 1.6 million barrels a day. Slowing demand in China is a part of that picture, and so I think those, we talk about geopolitics, but those are fundamentals of the market. So we perhaps are more fundamentally driven right now.
Yeah, physically driven. Aldo, just back to you on that. I mean, the IEA and OPEC, for example, have been at odds, and we have an article today by Crystal Energy on that. Just, we've had wide variances in their demand outlooks for this year and next year, for most of this year. Now, OPEC has adjusted those, but some people are saying not enough, considering, what we're seeing in front of us as evidence of demand. Do you think we'll see those outlooks and forecasts come closer together next year as it settles in that we are in a bearish market from a demand point of view?
Well, judging from past years, I mean, we see these divergences. It's not the first time that we've seen significant divergence. Well, maybe this is quite a pronounced one. But as the year progresses, we see them converging. And we're still, 3 months away or 2.5 months away from the end of the year, and some revisions that might come the first quarter of next year. So we'll see how far that divergence is. If there is a cycle of revisions, so we have to wait and see. That the experience that I've seen mostly is that usually OPEC tends to converge to the IEA's view. Usually the IEA's view being more bearish about demand growth, and but on the other, one thing to keep in mind is that the IEA has been extremely bullish about the prospects for alternatives to oil and gas and the growth of renewables, and that's still very much for discussion, and that's where I think OPEC is being more careful in its scenarios and forecasts.
Okay, thanks, Aldo. David, let's talk a bit about Europe and middle distillates. There's been, we've had a weakish sort of market, haven't we, for a while there? I mean, obviously reflected in the manufacturing activity, perhaps in Europe proper. What is the outlook for that? Any positive signs on the way, or more of the same?
Well, I think it's a struggle to find too much positive over the kind of medium term. I mean, look, it wasn't that too long ago, as you alluded to, we were like cracks in Europe for jet fuel, gas oil were up 30, 40 plus dollars a barrel. We're now a lot lower than that, right? That had been stimulated off the back of sanctions against Russia and adjustments around diesel flows, etc. The regional gas oil contract, gas oil now is around $14 a barrel on a crack basis versus Brent. Jet, so gas oil, that's kind of diesel, right? You alluded to the industrial side. Jet is a little bit stronger. It's about, but not much, only about 14.50. These had been up at about 21 back in July, so the market's weaker, but we've come off the back of the summer peak season for jet fuel. So unless there's we have a sharp colder snap, like the jet kero side, where you have some heat in demand, like that's not likely to strengthen. And on the industrial side, I mean, look, there's always the potential for, I mean, things in the market have been broadly balanced on the S&D, on the supply and demand side through the summer. Things might tighten a touch now, be a bit on the short side with refinery turnarounds going on.
Yeah.
But the region's a net importer on these products, and imports have been strong. The region's been well supplied with jet fuel and diesel. A lot of that, right, coming out of the Mideast Gulf, and the disruption that there had been around that region, and kind of this disruption to shipping has now really been recalibrated, and the market is kind of well adjusted to those flows, taking the longer route down around the Cape of Good Hope. So, look, obviously, if there was more geopolitical volatility, if there was anything that happened to disrupt flows coming out of the Mideast Gulf and around the Straits of Hormuz, then of course, like those would all be very bullish for European distillates.
Okay, thanks, Dave. Daniel, good to have you with us. While we have you, let's get a few words out of you before you disappear. Great that you could reconnect. I'm very glad we have you today, because obviously your country has been a focus of attention for the last at least 10 days in terms of how activity to and from it may impact the markets. Would you be with the consensus right now that's being demonstrated in the oil price that we're not going to see Iranian oil infrastructure under attack? Is that the point of view from Iran?
First of all, sorry for the internet disruptions I had, and I'm very glad to be here, and thank you for having me. Honestly, I'm not sure whether all these are going to be true, because the country is in a war situation. Nobody can guarantee that the oil infrastructure is not going to be targeted. But the whole Iranian energy sector, oil, natural gas, electricity, and refining sector are very, very seriously potential targets for the Israeli air raids or whatever kind of attack they may do. And they're all very vulnerable against any kind of disruption. Look, Iranian gas sector, natural gas sector, despite being the second largest gas reserves in the world and one of the largest gas producers due to very high level of consumption and more than 70% of primary energy dependence on natural gas in Iran, we have very significant deficit in the winter. Something about 320 to 350 million cubic meters of gas. Iran has an imbalance, about, as I told you, it's a huge amount. Iran's natural gas output, maximum output in the winter, is 850 million cubic meters, and just imagine 350 million cubic meter deficit you still have. So, and most of that gas is located in one single province of Bushehr off the coast of the Persian Gulf. So there is huge potential for all those huge refineries altogether being targeted. If so, big problem would occur to whole Iranian industry, including the petrochemical industry, electricity generation, whatever. So a kind of domino-like disaster, catastrophe would happen to whole Iranian industry and also the households in the winter. As you know, the northern part of the country is very cold in the winter. So, and
Okay,
again, there would be problems for Iraq and Turkey, which are importing huge amounts of gas from Iran, especially in the winter. So the natural gas sector could also be a potential target.
Yeah. And
Refining
of course,
sector,
even though natural gas would be, I mean, that would have its consequences, and that would immediately spur a reaction, I'm sure, also in the oil markets, because if that can be done, why would the attack on your oil facilities be done? Daniel, just staying with you, give us, because there's been a few news stories in the last week about sanctions being squeezed a bit tighter from Europe and the US on Iran, cargoes having a bit of difficulty leaving the ports because of not being able to swap and do what they usually do to get to their destination. Are you seeing any evidence of exports being impacted in the last week or two of oil?
The exports were impacted due to the concerns about the Hark Island being targeted. 95% of Iranian oil is exported through one single terminal in Hark Island. It's in the north part of the Gulf. But I think those actually interruptions are due to concerns of any kind of military action, not due to the sanctions. To be honest, there are only two countries that can really sanction Iran at the moment. One of them is China, which is importing 95% plus of Iranian crude oil. And the second one is the UAE, where you're living, where most of the funds are transferred to Iran through your banking system and your financial system. So apart from these two, which are the bottlenecks of Iranian energy and international trade, to some extent, Turkey, very little, Oman, but big amount. The backbone of Iranian actually money transaction system is in the UAE, and the Abu Dhabi government in a sort of a security deal with Iran in 2021 and 2023 has agreed with guaranteeing the money transaction and facilitating Iran with that financial system as a part of the Iran GCC rapprochement. So there are only two countries, I think. And Iran also has its own geopolitical leverages in Yemen, in Bab el-Mandab, in the Red Sea, elsewhere, to make such balance. So this balance is giving Iran a hand. I can say that Biden administration is happy with such agreement because it would facilitate more oil to the market, also would guarantee the security of energy flows here or there. At the same time, would reduce the tensions. At least the GCC countries will be kept apart in the safe corner in the conflicts between Iran, Israel, and elsewhere. So at the moment, I don't think that the European sanctions, just imagine that there is almost no real energy trade, or the other trades with the European Union or European countries would be replaceable with other sources in China or elsewhere. So I don't believe any very serious sanction would be imposed on Iran unless Americans want to step in and disrupt Iranian tankers actually flow towards China, reducing their force, which would have consequences for them in Iraq or so I don't believe at the moment such sanctions would be very.
That's been dismissed. I mean, I don't think the appetite for America to interfere with China's oil imports is not there. They've got enough to deal with China on trade and everything else. That's the sentiment. Anyway, thanks for that, Daniel, that comprehensive sort of update. Aldo, we have an article today on our bulletin, which is Mexico Steinbaum set to review public-private partnerships in energy. Can you educate us a bit on whether that really has any consequence to investment and what's behind it?
Well, we have yet to find out what the rules will be. What the new administration has done is to pass a set of constitutional reforms that basically pulled back on some of the effort that was made on the liberalization of the energy markets through 2013 to 2018, just about. I had a chance to participate in that process. So that's been scaled back with the idea of guaranteeing that the national energy companies, Pemex and CFE is for electricity, have a predominance in the market. What we see is an appetite for partnerships with the private sector, partly because Pemex is in financial strains. And the scale of the investments that are required in the electricity sector are also huge. So there's not enough financing from the Mexican government to get to the levels that are required. And we will have to see what the rules will be. This is something that should be more clear in the coming months.
Okay, thanks, Aldo. There's our survey question today. With a negligible geopolitical risk premium in the oil price, we might all agree or not agree on that, but it's certainly very low. OPEC Plus will have to delay again adding volumes back to the market, delayed it obviously from September to December, and we'll see what happens. But do you agree or disagree that the current trend line looks like they may have to push that? We have a few people this week who've said that. And even if they do increase in December, we had someone on yesterday who said next year they just, they'll have to kind of reverse that strategy, at least temporarily. David, let me go to you and talk about a little bit about sustainable aviation fuels. Aldo mentioned them earlier in the context of what generally the market is on track for in terms of renewables and how that might be challenging other products. What is the outlook for that? We have an article today which is US focused, offering conditional loan guarantees worth $3 billion for 2 projects in SAF. That's definitely making inroads, isn't it? Sustainable aviation fuel. But when are we going to see some real tangible deployment in volume?
Yeah, you're in various social media circles, there's a huge amount of buzz around SAF, right? There's like huge amounts of talk, and look, in all fairness to the US, it's where a huge amount of activity is going. It's perhaps the most activity and the most interest. So look, one of the big challenges is converting a lot of this positive sentiment. The big target is the aviation sector looking to decarbonize net zero by 2050. SAF, a drop-in fuel, earmarked as the way to really help get towards that goal. Look, there's a couple of things that we should look to over the next couple of months. The EU and the UK from 2025 will have a 2% blend mandate for SAF. So aviation fuel suppliers will have to incorporate 2% of SAF from things like used cooking oil and animal fats into the jet fuel supply stream. Production is still very low. Right? In the US, it is growing fast. Some expect production and output there to grow by 14 times this year. But in the overall global picture, SAF accounts for about 1.5 million tons. So that's under 1% of the aviation fuel market's needs for 2024. There's been I've seen some estimates this week that SAF will rise to about 12% of global aviation fuel demand by 2050. Right? So if the aviation, and that just goes to show, right, the challenge. If the aviation sector is looking to decarbonize to get to net zero by 2050, then can it achieve that on 12% of SAF demand? Probably not, right? I mean, not probably not. No, yeah. Not really. And there's, I think, the aviation sector is really now entering a period of has to enter a period of realism where it either looks to find ways, as you mentioned in the case of the US, this news that's out, and of finding ways to bring investment in and stimulating project finance to get so many dozens of projects that are there earmarked to bring them through to final investment decision stage and then actually bring that supply to market. But it's a challenge.
Okay, thanks, David. Daniel, just to go to you, you made a comment there, sticking to geopolitics a bit, that, the rapprochement between Iran and Saudi. Yes, and behind the scenes, who knows what's going on, but at least from a public perception point of view, that was the direction things were going in, wasn't it, up to a year ago? Of course, that's all been like completely blown out of the water. I mean, is there a mood in Iran that is still desired and a wanted relationship to strengthen?
I think at the moment Iran's major first priority is to keep pressure, military pressure and security pressure on Israel, while getting itself away from the flames of the fight. So this is a very, very hard work to do, because Israelis on the other side know well what is Iran's plan. Iran wants to put Israel under very intense pressure with whatever cost, let's say the least possible cost. But at the same time, wants to extend the length, actually the time of this pressure. So Israel will go back, because the society in Israel, the type of geography, the demography of the population, everything is very different with the rest of the Middle East. And high levels of security is required to keep Israel in the same position it has. At the same time, we all know that Israel lacks any kind of soft power in the region. 100 meters away from the borders with Lebanon, with Jordan, with Syria, with Egypt, everywhere, they are not very welcomed. This is the reality of this region. So they lack soft power in this region. So they need to keep actually reflecting their muscles. They need to fill the gap with their hard power.
They're certainly doing that so far. But Daniel, just to interrupt you there, just to go back on, somehow related, the nuclear. I just want to quickly ask you about the nuclear program, because this part of this, obviously back and forth between Israel and Iran rhetoric has been, well, if you hit our oil facilities, we'll ramp up our nuclear power, and sort of push on that front. Is Iran in any position to do anything on its nuclear program, really, with the sanctions and the breakdown there, really, in terms of
the nuclear power is a part of Iran's geopolitical, actually, plan or geopolitical approach. That is a tool to guarantee this actually, let's say, that the plan they have, whatever we can call it. So at the moment, based on intelligence,
Oops, we're losing the best bit. He's going to tell us about Iran's nuclear program. And
there you go. It's a cliffhanger now.
If we get Daniel back, we'll listen to what he's going to reveal to everybody here. Aldo, I'm going to go to you to close with us today. Let's stick to geopolitics, but politics more. Let's talk about America. We have an election there, obviously, and within 3 weeks, we'll know if Trump is back. And if he is back, in your opinion, what difference would it make to sanctions policy on countries like Iran, but also on, more specifically, nearer where you are, on Venezuela? Has that sort of loosening of opportunity been closed already by Biden that we saw earlier this year on Venezuelan exports? And what would a Trump presidency do to that flow, if you like?
Well, what a question.
I mean, where are we at with the Venezuelan? With the Venezuelan sanctions, where are we at now in terms of that slight reprieve that we saw earlier this year from America?
Well, we're still there. Then again, we're seeing projects like that of, Chevron is still doing its business. So there's an understanding there about having some working relationship within the confines of what has been deemed acceptable. It seems, based on the interviews and news, that Trump administration will definitely be less forgiving or more aggressive, whichever way you want to put it, with respect to some of the challenges it has abroad. That includes Mexico, by the way, and because we have so much so many issues to work with, and notably the coming renewal of the new North American Free Trade Agreement. So that's in the equation here. In any event, even if Kamala Harris wins the presidency, it doesn't look like things are going to be easier. The issues that matter right now to the American public and to the politicians are delicate, and both at home and abroad. So we can expect a firm position from the U.S. on any of these challenges.
Okay, thanks.
But we were waiting for the comment, right?
Yeah. So Daniel, I'll give you 1 minute, Daniel.
Yes.
So where's the nuclear program? And okay, you're saying it's being used as political leverage, but physically on the ground, any movement possible?
On the ground, I don't think it is going to be a bomb is going to be constructed anytime soon, but politicians are more frequently speaking about the necessity of making a balance with making a bomb. So that is in contrast with the fatwa of the leader here in Iran. But now very openly, military actually officials and also political speakers are speaking about that. They may add something about the closure of the Strait of Hormuz, which is now spoken widely. The closure of Strait of Hormuz physically is impossible. Even keeping that closed with using military equipment forever or for a long period is impossible. But disrupting the flows, just something like the Bab el-Mandeb Strait, or even harsher, is very possible, which would increase the risk of the energy flows in the global market, which would add huge amounts of war premium, actually risk premium to the prices. That is a point you need to consider. You do not need to target every tanker passing through the strait, but if you can target more than a certain level, that would be a huge disaster to the market. So that is an option on the table, I think.
Yeah, too many destabilizing factors these days. But thank you so much, Daniel. Thank you, David. Thank you to Dr. Aldo for joining us, particularly late at night there in Mexico. And have a great weekend, everyone.
Thank
All
you.
the best.
Thank you.
Likewise.
Thank you so much.
Take care.
Thanks.
Bye.